Are you a property owner looking to save money? You might be missing out on valuable tax deductions. Welcome to our video on Real Estate Tax Deductions Explained for Property Owners. In this video guide, we'll reveal the secrets of maximizing your tax benefits. From slicing your mortgage interest to cracking the code on property taxes, we make it easy to understand and apply these financial perks. Whether you're new to the real estate game or looking to optimize your current investments, our video is packed with essential tips and tricks. And we have a special gift for our viewers at the end of this video. But before starting the video, if you are new on our channel, hit the subscribe button and turn on the notification to get more taxes and accounting videos. Introduction to Real Estate Tax Deductions. As a property owner, understanding these deductions is crucial for financial savvy. Essentially, tax deductions reduce your taxable income, meaning you pay less tax. They cover various expenses like mortgage interest, property taxes, and even certain improvements. For homeowners and investors alike, these deductions can lead to significant savings. It's not just about paying less, it's about making the most of your investment. So, whether you're renting out a property or enjoying your dream home, getting to grips with real estate tax deductions is a smart move. Let's break it down, simply and clearly. Understanding mortgage interest deductions. Did you know that as a homeowner, you can often reduce your taxable income by deducting the interest paid on your mortgage? It's true. Here's how it works. When you file your taxes, include the interest you've paid over the year on your mortgage. But remember, there are limits. For example, if you bought your home after December 15, 2017, you can only deduct interest on up to $750,000 of mortgage debt. Now, imagine you paid $10,000 in interest this year. That's $10,000 less of your income subject to tax. Isn't that a great way to save? Do you know how much you could deduct this year? Property tax deductions. Property tax deductions can be a game changer for homeowners. Here's how they work. Each year, you pay taxes on your property's value, right? Well, you can actually deduct these taxes from your federal income tax. But there's a catch. The total deduction for state and local taxes, including property taxes, is capped at $10,000. $5,000 if married filing separately. So, if you paid $3,000 in property taxes this year, you can reduce your taxable income by that amount. Think about it. How much did you pay in property taxes? Could this deduction make a big difference for you? Depreciation. Benefits. Depreciation is like a hidden gem for property owners, especially those with rental properties. It allows you to deduct the cost of buying and improving a property over its useful life, acknowledging that properties wear out over time. For example, if you buy a rental property for $300,000, you can't deduct this entire cost in 1 year. Instead, you spread it out, typically over 27.5 years for residential property. So, each year, you could deduct about $10,909 from your taxable income. Think about your property. How old is it? Could depreciation help lower your tax bill year after year? Repairs and improvement deductions. In real estate, understanding the difference between repairs and improvements is key for tax deductions. Repairs, like fixing a leaky faucet, maintain your property's current condition and can be deducted fully in the year they're made. Improvements, however, like adding a new roof, increase your property's value and must be depreciated over time. So, if you spend $500 on repairs, you can deduct that amount this tax year. But if you invest $5,000 in a new roof, that cost is spread out in deductions over several years. What changes have you made to your property recently? Repairs or improvements? Rental property. Specific deductions. Owning a rental property comes with specific tax perks. You can deduct a variety of expenses, including mortgage interest, property taxes, maintenance costs, and even advertising expenses. For example, if you spend $1,000 on advertising and $2,000 on repairs, these costs can be deducted from your rental income, lowering your taxable amount. Moreover, don't forget to keep detailed records of all expenses and income. This makes tax filing smoother and ensures you're maximizing your deductions. Think about your rental property. What expenses did you incur last year? Are you tracking them efficiently for tax purposes? Home office. Deductions. Home office deductions are a boon for many, but they come with specific rules. To qualify, the space must be exclusively and regularly used for business. For example, if you're a freelancer using your spare bedroom as an office, that space could qualify. How do you calculate it? Measure your office area and divide by your home's total area. Suppose your office is 100 square feet and your home is 1,000 square feet. That means 10% of your home expenses, like rent, utilities, can be deducted. Think about your workspace. Does it meet these criteria? Could this deduction benefit your tax situation? Energy efficiency. Upgrades. Going green with your property isn't just good for the planet, it can also lead to tax incentives. Many governments offer tax credits for energy-efficient home upgrades. These can include installing solar panels, upgrading to energy-efficient windows, or adding insulation. For example, you might receive a tax credit for 30% of the cost of solar panel installation. This means if you spend $10,000 on solar panels, you could get $3,000 back in tax credits. It's a win-win. You save on energy bills and get a tax break. Have you considered making eco-friendly upgrades to your property? Capital gains. Exclusion for selling a home. When you sell your home, you might face capital gains tax on the profit. However, there's a generous exclusion. If you've lived in and owned the home for at least 2 of the past 5 years, you can exclude up to $250,000 of the gain from your income, $500,000 for married couples filing jointly. For instance, if you bought your home for $300,000 and sold it for $550,000, the $250,000 profit could be tax-free for a single filer. Are you planning to sell your home soon? Have you lived there long enough to qualify for this exclusion? Avoiding common mistakes. Navigating real estate tax deductions can be tricky, and small mistakes can cost you. A common pitfall is not separating personal and rental property expenses. For instance, if you use a property partly for personal use and partly as a rental, you must allocate expenses accordingly. Another error is overestimating the value of home improvements, leading to incorrect deduction claims. To avoid these, keep detailed records of all expenses, understand the specific rules for each deduction, and consider consulting a tax professional. Ask yourself, are my records detailed and accurate? Am I clear on what's deductible and what's not? In conclusion, mastering real estate tax deductions can be a game changer for your finances. And here's a special gift for our viewers. We're offering a free consultation call with our expert tax professionals. Just check the link in the video description to book your call. This is our way of saying thank you for being part of our community. If you found this video helpful, show your support by liking, sharing, and commenting below. Your engagement means a lot to us. Don't forget to subscribe to our channel for more valuable content and gifts like this. Together, let's navigate the complexities of real estate taxes and make smarter financial decisions. Thank you for watching, and we're looking forward to seeing you on that free call.